When it comes to accounting, there are many ways to write out the balance sheet and other applicable financial reporting documents. The United States developed the GAAP to standardize the process. Not only did this make things easier for companies, but it also helped with investors and other parties when it came to reading and interpreting the documents. However, as business has moved to an international scale, there have been problems with the processes used during financial reporting. The IASB was formed to provide guidance to companies all around the world, but due to established practices in organizations in various countries, the rulings of the IASB can sometimes contradict what a company is used to doing. This paper will review a couple of changes to accounting principles put forth by the IASB and analyze the impact that they've had on GAAP in the United States. Two of the most recent changes put forth by the IASB are amendments to pension accounting standards and the IFRS 15, which is a change with recognizing revenue. The first change is that of pension accounting. Originally, when pension plans were changed, a company was required to update certain parts of the financial statements. This included a company's obligation and the fair value of the plan's assets. The new changes require a company to report the current service cost as well as the net interest for this period. These changes came about when companies were non-standardized in their reporting of pension-related financial activity. For example, when employees contributed their own pension, the amount was not being recorded on the company's financial forms. This presented the readers of a company's financial statements with a skewed picture of how much money the company had tied up in pensions and how much they needed to contribute in order to meet their obligations to their employees. The second example of a change that the IASB is making is the changes of the IFRS 15. This affects how companies recognize revenue. The proposal came about because there were differences in the definitions of revenue between different companies. This could cause reported revenue to be artificially high or artificially low, depending on the process used by the company in question and the understanding of the reader who's looking at the financial statements. This matter was so important that the IASB worked hand in hand with the FASB, its American counterpart. IFRS 15 detailed a 5-step plan for handling the reporting of revenue. Step 1. Identify the contract with customer. Step 2. Identify the separate performance obligations in the contract. Step 3. Determine the transaction price. Step 4. Allocate the transaction price to the separate performance obligations. And Step 5. Recognize revenue when the entity satisfies a performance obligation. This new process dictates that the revenue will not be recognized until after the entity satisfies the task for which they are being paid. Companies have recognized revenue as soon as the contract is complete in the past, and this is at direct odds with the accounting principles being pushed out currently by the IASB. Revenue recognition, like what we mentioned above, continues to be a high priority for the IASB and for the FASB. While the IASB generally tries to adhere to, or at least complement GAAP, there are going to be obvious differences, and this has the potential to create conflict. The aforementioned example of revenue illustrates this point. The IASB and the FASB work together so that the IFRS and GAAP align. This is ultimately best for everyone involved. Most companies, and potentially all the companies in the United States, are able to continue financial reporting as they have been doing it. However, in the case of the pension example, companies will need to stray from GAAP practices and get in line with the requirements of the IASB. This has the potential to disrupt the financial reporting of companies who were reporting the finances attributed to pensions differently under previous GAAP guidelines, and this could potentially make those GAAP guidelines irrelevant. In conclusion, the transition from local to globalized business has opened many doors, but has also given rise to many changes and potentially problems. The ability to read a financial statement can differ from country to country. The IASB has set out to fix this by issuing a set of international accounting standards. Two examples mentioned in this paper were pensions and recognizing revenue. These changes, however, have the potential to conflict with the U.S.'s GAAP. To alleviate some of the stress put on financial accounting, the IASB and FASB have teamed up to make sure the transition to international standards is beneficial to both customers and reporters. However, there is still the possibility of changes issued by the IASB conflicting with GAAP. Understanding these differences and initiating changes in accounting procedures at the company level are the best way to deal with these conflicts.